G'day guys, Brad Flynn here, and haven't done a video for a while, but I wanted to get back into it and give you a different take on an income statement and take you through an example. And you'll see there's some interesting things here behind me that I'm going to show you to help you understand how an income statement flows and works and so forth. So there's a tap there which is giving you a bit of a hint. So let's go back to our example. An income statement is constructed of these key areas: the income into the business, the cost of sales, and the gross profit. Fixed expenses, profit, and then net profit. So let's look at how it's constructed with an example to start with. So income, sales, revenue, all mean the same thing. So in this business, we've got 12-month time frame we're looking at here, $500,000 worth of income or revenue. Cost of sales. Now, cost of sale is a cost you incur because you get a sale. Usually applies to what you're buying. So if you're buying a widget for $1 and you're selling it for $2, your cost of sales is $1. That will go in this section of your P&L. And then your gross profit is made up of income minus cost of sales. In this instance, 500,000 minus 250 gives us gross profit for the business of 250,000, or 50%, which is 250 as a percentage of 500,000. Fixed expenses. These don't move. That's why we call them fixed. So in this business, this is what it takes to run the business: wages, electricity, rent, insurances, all those sorts of things. So in this example, I've got $200,000 worth of fixed expenses. So moving down, our gross profit is 250,000. Now we subtract our fixed expenses of 200, we have a profit of 50,000. Now here's where it gets interesting. Profit, EBITDA, EBITDA, earnings before income tax, depreciation and amortization, which is basically before the government or your tax man gets to it. This is what we use to start with our accountant for them to do their magic and help us minimize our tax. So in this instance here, I've got an example that, let's say we've paid $10,000 worth of depreciation and write-downs and all of those sorts of things here. Now our profit is our net profit, which is the bit that we get assessed for tax on, is $40,000, or roughly 20% of what we earned here. 20% of our profit is going into our tax, so into our net profit. Now let's look at it a different way. I want you to imagine now that income is like a tap in your business where the money is water and it's flowing into this top vessel here. This is our cost of sales bucket, vessel, whatever you want to call it. And this needs to fill up and overflow first, because we have to pay for what we sell. So this is how it works in here. Now, we're not paying for it as it comes in, but I want you to understand how it hangs together. So once this fills up with our revenue, then it flows over and runs into our gross profit bucket. Okay? We've got to pay for our goods first, and whatever's filled up here flows over into our gross profit bucket. Now you'll notice that we've got a hole here, because this then flows through to run our fixed expenses for the business. Okay, so we've got to pay for these fixed expenses as well. Once that has filled up, so the water's flowing in here, and this then fills up. Once our fixed expenses have all been paid, then whatever's left over flows down in here into our profit bucket. All right, now this isn't our last profit bucket, because you'll see over here, there's a man with a hand or a woman with a hand and a cup. This is the government. This is where they're going to come along and they're going to take a scoop of your profits to go to running taxes and the rest of it. Whatever that percentage is, depends on your business. Whatever percentage that is. In Australia, it's about 20 to 30%, although that varies greatly. Now, whatever's left, your accountant or the government or whatever, if you like, will open up this bucket, and all of that will flow through into what I call your net profit. Now you can think of your net as being at the bottom, which catches everything that's left over. And that's the bit that you get to keep. Okay, so your net profit is after the government and everyone has had their chop at it. So you can see how it flows into our cost of sales. We've got to pay for what we sell. Then it flows into our gross profit bucket. That's just a way to measure. It's a look at the effectiveness of your sales and your margin. Then it drips through to our fixed expenses. Once we've filled our fixed expenses bucket, then the money that goes in here flows into our profit bucket. Once the government takes their bit out at whatever time of the financial year or afterwards they do that, then we can open that up and whatever is left flows down into our net. Hopefully that helps you understand income statement explained with an example, how it all flows together, and you make sense of it. If you've got anything else you'd like to know, by all means reach out. I have a cheat sheet down the bottom you can access that'll help you understand all your financial statements, and I look forward to helping you making more money in your business.